Welcome back, you legends. I'm Dr. Callum and I'm going to try to blow through this as fast as possible. Please go into your video settings, click on playback speed, set it to 1.25 to get through this video much more quickly. I have some critical information in this video. Please do not skip any part. I will cut out all of the fluff. You will only get the distilled essence of what is happening in the market. So let's get right into it. The stock market today closed flat on the S&P 500, the NASDAQ down 0.6%, and the Dow Jones also closed flat on the day. Let's take a look at the different sectors. Energy came back roaring today, leading with 2.3% in the green. Financials, industrials, basic materials, and real estate showed some minor gains today. Communication services flat, utilities basically flat, cyclicals and defensive slightly down. Tech down 0.7%, and healthcare the laggard today. It's kind of rare to see healthcare lagging the market, so this is very interesting. So this is a very interesting mix today. It's a bit of a weird mix. It's not risk on, it's not risk off in terms of the different sectors, but there's a clear pivot, guys. Look at this. Energy, financials, industrials, basic materials, all of the inflation-centric sectors in the market are up. If we take a look at the stock market map again, banks are up because they're expecting interest rates to rise. Capital markets are up for the same thing. Insurance, banks, regional banks, and energy stocks. Some entertainment stocks are up today off that nice earnings report from Disney. The company managed to eke in a 10% beat on the profits and a minor beat on revenues. So let's jump straight into the S&P 500. This is a daily chart of the S&P 500. And finally, today we broke past this resistance line that we had drawn up. We were ping-ponging near this line. We did not manage to break through until today. Let's take a look at the 2-hour chart. Look at that, guys. We stuck right to that line yesterday. We blew through this line today after the PPI came in at minus 0.5 percentage points month on month. The inflation measure that looks at cost of production, cost of goods, is down 0.5 percentage points. The difference, guys, between the CPI and the PPI is that PPI tends to lead CPI, right? So when your cost to produce things, when your cost of materials is up, as a company, you have to raise prices on your final products, and that leads to an increase in CPI, and vice versa. When your cost to produce goes down, the cost of the final product is down. That leads to a decline in the CPI. So this is really good news, guys, for inflation. We might be seeing inflation peaking. We might. But I just spotted a major warning sign, and that is commodities. DBC, this is the commodity index. Look at this, guys. We had a double bottom formation with positive divergence. We are now rallying after that CPI and PPI reports came out. Same thing with oil here, guys. We have a double bottom right here with a lower low on the price action and a higher low on the momentum. So this is super bearish, guys. This is so bad. This is kind of a surprise. What you would expect when you see CPI declining and PPI declining or slowing down is that for commodities to continue to roll over, but this is not what we're seeing. Basically, what we are seeing, guys, is that the market is betting that the Fed will screw this up. They're betting that the Fed will begin to pivot soon, much sooner than needed, and that pivot will lead to a massive surge back in inflation. And that's what the market is betting on. That's why you see oil moving up. That's why you see the commodity basket, the commodity index moving up. So this is really bad news. And let's go back to the 2-hour chart for the S&P 500, guys, because this is very important. Look at that. We blew past this resistance line, and then we closed right below it. This is so bad. And if we take a look at the daily chart for the SPX, so this is the S&P 500 index, not the ETF, the actual index. Yesterday, I talked about how this is the final test. This is the final test, the most important test of the year for the stock market. Will we be able to close above this 50% retracement level? Every single time the stock market declined by more than 20% on a closing basis, and then had a rally that retraced 50% of that decline and then closed above the 50% retracement level, that signaled the end of the bear market, and that meant that this is the low, right? What happened today? Today, exactly what you would expect if you were a bear. We blew through, we blew past the level, and then we closed below. This is exactly what happened in 2000, guys. This is exactly what happened in the 2000 bear market. We had a 50% retracement that really touched the retracement level, but ended up closing below. So again, two massively bearish developments. We have this development basically telling us that the market participants do not think for a second that this is the last low, that we will probably make another low. This is consistent with what I've been seeing in terms of technicals on the S&P 500. I've been talking about how the NASDAQ has probably bottomed, but how the S&P 500 will probably make a lower low. In fact, I'm still targeting around 350 bucks on the SPY ETF by September, possibly into October. We could go lower than that. We could come in slightly higher than that. That remains to be seen. But so far, it appears that this rally may be running out of steam. Again, guys, all of this could change if we close tomorrow. If tomorrow we see more bullishness and then we close above this 50% retracement level, that would absolutely change the thesis. But so far, I'm seeing a bunch of warning signs that do not look good at all. And again, on the 2-hour chart, guys, for the S&P 500, we still have this nasty negative divergence. Look at that. We made a higher high compared to this high right here, but we made a lower high on the momentum. Again, another sell signal to the downside. I did, in fact, open additional puts. I bought more puts. Puts are a bearish position, a bearish options position. If you don't know what puts are, they're basically insurance contracts that make a profit if the price of the underlying goes down. And I did in fact buy $400 puts. I puts on the $400 strike that expire on the 30th of September for the S&P 500. Again, guys, if you're interested in following my trades, my technical analysis, all of that good stuff, my buys, my alerts, my investments, you can check out the link in the description. It's 20 bucks a month and you get access to all of that good stuff in the Discord group. You can find it in the description below. If you want to support me, you can do that. Other ways to support me, you can like, subscribe, comment, all of that good stuff. It helps with the algorithm, and I massively appreciate it. Now let's jump into the triple Qs. The triple Qs actually are seeing relative weakness compared to the S&P 500. Again, that's not what you want to see when you're in a bullish uptrend. You want to see the triple Qs outperforming the S&P 500. We have this bearish engulfing candle that opened above the highs of yesterday and closed below the open of yesterday's candle. So again, I'm still bearish. This is an insanely frothy rally led a lot by short squeezes in the highest short interest stocks like AMC, GameStop, Bed Bath & Beyond, and so on. Let's take a look at the IWM. We have this pretty sizable rejection candle right at the top of this Bollinger Band. This is a tombstone candle. It's an extremely bearish candle. We had another one right here, but a red candle is significantly more bearish than a green candle, right? Because it means that price rallied and then got rejected and closed below the open of the day. Again, all of these signs are pointing towards a top in this rally. We might have some more steam. We might just doodle around for a bit until that late August, when we always, guys, in midterm years have a massive sell-off towards the end of August, early September. I do expect to see that massive sell-off come in. I have not changed my mind on that. Let's take a look at the Dow. Again, look at this, guys. The Dow Jones has put in a higher high today. It is outperforming the triple Qs. That's not what you want to see. The Dow is more value oriented. It's more defensive. So you don't want to see that when you're rallying. Again, this is a warning sign. Now let's jump into the VIX. The VIX did spike up today, forming somewhat of a basing candle, right? A doji, a shooting star candle. I would prefer to see a candle with a narrow body and a long wick to the downside to signal a bottom, but we don't always get that with the VIX. So still, I'm waiting for that bullish crossover on the MACD, on the PPO, to book our last and most important sell signal, the VIX sell signal. We're still waiting on the VIX sell signal. We might get that Monday, I'm a bit suspect of tomorrow. I think tomorrow might be a little bit flat. Friday tends to be a slower day, so we'll see what happens. But I suspect that Monday we might see a bullish crossover. Let's take a look at Tesla. Tesla continues to show weakness as the market has been putting in higher highs. Tesla has been putting in lower lows. Lower highs, and now we have this bearish crossover on the PPO. We have that court date on, I think, 20th of October, 19th of October, something like that. We have negative seasonality coming in September, October, and we have that court date with the Twitter lawsuit that's going on. That's coming in late October. So I think shorts will continue to pile onto Tesla. A full measured move again, guys, will take us down to about $500. This full measured move can be extrapolated by taking the high of the previous move to the low, and then you put that towards the high of the last move, and then to the low. That's how you would extrapolate the full measured move. Let's take a look at Nvidia. Now let's take a look at Nvidia, guys. Look at that nasty rejection candle on Nvidia, and in fact on all of these semiconductor stocks. Basically, we had this really nice rally after breaking out of this descending wedge. I was talking about Nvidia and AMD a lot in this period right here about how it was probably a really nice accumulation zone. I'm still waiting for a retest or a test because we haven't tested it yet. This lower edge of the ascending channel. This channel goes back to 2016. We've been trading within this channel perfectly for the past 6 years. I do not expect that to change anytime soon. So I'm expecting something like that, a touch of the ascending channel towards the end of September, possibly into October, and then we might see a little bounce. It all depends on what happens with the economy. A lot of other things are happening, guys. There's some trouble brewing with Taiwan and China, and I'm really worried about a possible China-Taiwan war. That would be absolutely devastating for the economy. The most advanced chips in the world, including every single processor in your iPhone, is made in Taiwan. And if a war breaks out, it'll be absolutely apocalyptic. It'll be so bad. So I'm really worried about that. So I'm bullish long term on the semiconductors as long as nothing crazy happens with Taiwan. If something crazy happens with Taiwan, I will absolutely need to flip bearish and unload all of my AMD positions that I did open right here. I bought $100,000 worth of AMD shares at $77 on June 30th. So I got really lucky in coming in close to the low. I do think that the low is in AMD. I've been trading within this channel again since 2016, this really long green channel. It goes back to 2016. So maybe a nice retest to the upper edge of this descending channel, maybe into October, around $80. That'll be a good place to load up on leap options. Let's take a look at these semiconductors. Yesterday, I talked about how these semiconductors have probably topped. Look at this beautiful resistance line. We've tagged it now twice. Once we closed near it. It's the second time we completely rejected it. And why do I keep bringing up semiconductors? Guys, semiconductors are the best performing sector in the market. By far, they're the fastest growing sector in the NASDAQ. I always use semiconductors to gauge market sentiment. Semiconductors are, in my opinion, the most important sector in the entirety of the NASDAQ. So if you're trading the NASDAQ, if you're trading tech stocks, you will want to keep an eye on semiconductors. If semiconductors are strong, that's a good sign for the economy and for the NASDAQ. If they're weakening, that's a bad sign. And they're weakening as of right now. But again, I still remain somewhat bullish on semiconductors in terms of the long term. Short term, I still think we will see some selling. Let's take a look at AMC. AMC continues to show strength after strength. Look at this beautiful green candle. Look at how different these two moments in time look. We had this massive breakout, a massive rejection candle or an indecision candle at the top, and then we reversed. This time we had a massive rally, a rejection candle, and then we continue to climb up. So there's still some frothiness left in the market. How high AMC can go, I have no idea. But I think the rally is coming to an end pretty soon. Let's take a look at GameStop. GameStop is weakening. It's significantly weaker than AMC as of right now. We had a rejection right here. We did not manage to clear this high. If we clear that high on AMC, I will be significantly more bullish on AMC. but so far AMC and GameStop both haven't managed to clear previous highs. Bed Bath & Beyond, I'm still bullish on Bed Bath & Beyond, unlike AMC and GME. I like the fundamentals on Bed Bath & Beyond. I think the valuation is so cheap. I like this double bottom right here. I did buy shares today. I bought a lot of shares at $10.9, about $70,000 worth of shares. I bought 6942 shares. I did choose that number on purpose. Now, let's take a look at the 10-year yield, and look at that, guys. As expected, we're moving back up. We're possibly forming a second shoulders, right? We had a left shoulder here, a head, and then a right shoulder is forming as we speak. The 10-year yield is suggesting that, again, the Fed is probably bluffing. So the 10-year yield, bond traders are betting that the Fed is lying and that inflation will come roaring back. They do not trust that the Fed will manage to crush inflation. That's the reason we're seeing this small rally in the 10-year yield. And on the dollar index, again, look at that dollar index. Even after we broke below this massive ascending channel, I did say yesterday that we've probably seen the highs in the dollar. I still believe that. I think the dollar has probably topped. And this significant weakness in the dollar has significantly helped the stock market rally massively over the past about 6 weeks. So this has been an important development. This breakdown is an important development. This weakening of the dollar is an important development. Again, because it feeds into commodities, guys. A weak dollar means commodities are more expensive, because all commodities are traded in the global markets in dollars. So again, look at that. DBC commodity index is moving up. Oil is moving up, and the 10-year yield, look at this, guys. Excuse me, not the 10-year yield, the 210 yield curve has inverted very deeply. This is the deepest inversion, and I think probably the last 40 years, if I remember correctly. This is the deepest inversion since the 80s, and the deepest this inversion gets, it predicts a deeper recession in the future. An inversion in the yield curve, guys, basically means that bond traders are selling short-term bonds, so 2-year bonds. They're selling those and they're buying the 10-year bonds, and that leads to an inversion in the yield curve where the 10-year bonds end up having a significantly lower yield than the 2-year bonds. That's a bearish sign, a significantly bearish sign. The yield curve inversion, guys, predicted every single recession in history. This indicator has been 100% accurate in predicting recessions. And just let's take a look at the past few times that it predicted recessions. Right here, 1990, we had a recession. Again, right here, 2000, we had that recession. Boom, again, 2006, we had that recession later, about a year later, 2 years later. Boom, even here, even ahead of that COVID recession in 2020. It predicted it. The yield curve predicted that recession would come. And now, again, it's predicting that a recession is coming. Usually the yield curve inversion has a 6 to 18 month lead time. So a recession will probably come in the next 6 to 18 months. We will see what happens. Let's take a look at the beat data, the earnings beat data. It's sitting at 62%. This is a horrendous reading. This is one of the worst readings in a long time. We want to see this reading around 75 to 76 and up. 62% is a bad reading. It indicates that earnings are disappointing significantly. Even though earnings estimates have come down, still companies are not managing to beat those earnings estimates. Tomorrow we will have the right here 5-year inflation expectations. We will see what happens with this figure. Hopefully it remains flat. If we see a spike in inflation expectations, that will be very bearish for the economy and the stock market. Consumer sentiment, hopefully this will continue to improve. Otherwise it'll be a really bad signal. Again, guys, I still remain bearish. The market did in fact fail the ultimate test today. We might pass the test tomorrow, next week, I don't know. But today the market failed, and we should just trade the charts that are in front of us. And the charts in front of us are saying that we will get a massive recession and a continuation of the bear market, and we will see those lows in June get taken out sometime in the future. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Wow.